Open almost any professional trader's chart and you will see one smooth, curving line tracking the price. That line is a moving average. It is the single most popular tool in all of technical analysis, and for good reason. It takes the messy, jagged noise of price and turns it into one clean line that tells you at a glance which way the market is really leaning. By the end of this video you will know what it is, the difference between the two kinds you will see, what the famous 20, 50, and 200 settings mean, and the 3 ways professionals use it every day, as a moving floor under price, a read on the trend's health, and a warning when the trend is about to turn. We will learn it on a clean diagram first, then read it on 3 real stocks. Let us build it from the ground up. Before any real chart, here is the whole idea on one simple diagram. First, what is a moving average really? It is the simplest idea in trading, dressed up with a fancy name. Take the closing price of the last 50 days, add them up, and divide by 50. That is the average over those 50 days. Now do that again tomorrow, and the next day, always using the most recent 50 closes, and those numbers connect into a single smooth line that glides along under the price. That is all a moving average is, the average price, recalculated every day, so it moves along with the market, smoothing out the daily noise to show you the underlying direction. Now, there are 2 flavors of this line. The one we just built, where every one of those 50 days counts equally, is the simple moving average, the SMEMA. The second is the exponential moving average, the EMI. It does the same job, but it gives the most recent days more weight than the older ones. The practical effect is just this: the EMA hugs price more tightly and turns faster, so it reacts sooner when the trend shifts. Smoother and steadier versus quicker and more sensitive. That is the whole difference. Next, the settings. You will hear traders talk about the 20, the 50, and the 200. That number is simply how many days the average looks back, and it sets the line's personality. The 20-day is fast and close to price, the short-term trend. The 50-day is the medium-term trend, the one swing traders watch most, and the 200-day is the slow, heavy line that defines the long-term trend. When price is above its 200-day average, the big-picture trend is simply up. Short, medium, long, fast to slow. That is all the numbers mean. Now the most useful idea of all, and it is beautifully simple. The slope of the line is the trend. On our diagram, price is making higher highs and higher lows, so the average would slope up, and a rising average means buyers are in control and the trend is healthy. If it rolls over and points down, sellers have taken over. And if it goes flat, there is no trend. The market is just drifting. You do not need to guess the trend anymore. The tilt of that one line tells you. And finally, crossovers. When you put a fast line and a slow line on the same chart, the moment the fast one crosses the slow one is an early warning that the trend may be turning. The fast line crossing up through the slow line is the famous golden cross. Crossing down through it is the death cross. We will see a real one shortly. So that is the whole foundation: an average that moves, with a slope that reads the trend, and crossovers that warn of a turn. Now let us read it on 3 real stocks. Our first example shows the most useful thing a moving average does in an uptrend. It becomes a moving floor that price keeps bouncing off. This is Caterpillar through February, March, and April. And we read every chart the same way. Put the average on first, then watch how price behaves around it. So here is the blue line, the 50-day moving average. And the very first thing to notice is its slope. It is clearly pointing up, climbing from around 620 towards 720. You already know what that tilt means. The trend is healthy and buyers are in control. So right away the line is telling us to be looking for price to go up, not down. Now watch what happens each time price pulls back. In early March, price dips down and touches the rising line, right around 676. Instead of breaking through, it bounces. Buyers step in at the average and lift it back up to 716 within a few days. This is the key idea in a healthy uptrend. The moving average acts like a floor. It is not flat and horizontal like a normal support level. It is a dynamic one, sloping up with the trend. But it does the same job, catching price. And here is what makes it tradable: it does not happen just once. Watch the middle of March, then late March, then early April. Price pulls back to the line and holds and bounces over and over. Each touch that holds is the trend proving itself, and it gives a patient trader a clean, low-risk place to join the move. Wait for price to come back to the rising average, rather than chasing it at the highs, and the payoff is right there. As long as that floor kept holding, the uptrend kept running, pushing Caterpillar to new highs above 770. So the first job of a moving average is simple in an uptrend. Treat the rising line as dynamic support, and look to buy the dips into it, not to fight them. Our second example shows how moving averages warn you when a trend is about to change, using a crossover. This is Texas Instruments across about 5 months, and this time we put two averages on the chart, the 50-day in blue, our fast line, and the slower 100-day in amber. The whole concept in one sentence: when the faster line crosses the slower one, the recent trend is overpowering the older one. Your early signal that momentum has flipped. Watch it happen twice in opposite directions. Start on the left. Back in late September, the fast blue line crosses down through the slow amber line. That is the death cross, a dramatic name for simple event. Short-term momentum has turned down and is dragging the longer trend with it. That crossover was the warning, and sure enough, Texas Instruments slides from around 182 down to the high 150s over the next couple of months. Now watch the right side, because the same tool calls the bottom. Through December, the selling dries up. Price grinds back up, and in late January the fast blue line crosses back up through the slow amber line. That is the golden cross, the mirror image, momentum turning back up, and look at the payoff right after the cross. Price does not just drift higher, it accelerates, running from around 196 up past 224 in barely 2 weeks. The crossover flagged the turn before the big move. Now, one honest warning: crossovers lag. These lines are built from the last 50 and 100 days, so the cross always prints a little after the actual low or high. You can see price had already started moving before each cross confirmed. So a crossover is not a precise entry trigger, it is a powerful trend change confirmation. Use it to tell you which side of the market to favor, not to call the exact bottom tick. Our third example is the exact mirror of the first, and it locks in the whole idea. In a downtrend, the very same moving average flips its job. It stops being a floor and becomes a ceiling. This is Uber through December and into February, and look at the line straight away. This time it is sloping down, falling from about 93 toward 83. That downward tilt is sellers in control. So now we should be looking for price to fail, not to fly. And that is exactly what it does. Watch each time price tries to rally. In early December, price climbs up to the falling line, around 92, and gets pushed straight back down. It could not get above the average. In a downtrend, the moving average acts as dynamic resistance, a sloping ceiling. Dropping with the trend, that caps every bounce. And just like the floor in our first example, this works because it repeats. Early January, mid-January, late January, 4 separate times price runs up into that falling average, and 4 separate times it is turned away. Every one of those rejections is the downtrend reasserting itself, and it hands a trader a clean, repeatable place to look for shorts into the falling line, not at the lows. And the result is right there. Because every rally died at that moving ceiling, Uber kept grinding lower, all the way down toward 71. So put the two halves together and you have the whole rule. In an uptrend, the rising average is a floor. Buy the dips into it. In a downtrend, the falling average is a ceiling. Sell the rallies into it. The direction of the line tells you which game you are playing. Let us lock the whole thing into one checklist you can screenshot and run on any chart. 5 lines. 1. Read the slope first. Up means an uptrend, down means a downtrend, flat means no trend, so stand aside. The slope is the single most important read. 2. Is price above or below the line? Above a moving average is bullish, below it is bearish. That one glance tells you which side of the market to favor. 3. Trade the touch. In an uptrend, buy the dips back to the rising line, where it acts as a floor. In a downtrend, sell the rallies into the falling line, where it acts as a ceiling. 4. Pick your speed for the job: the 20-day for the fast trend, the 50-day for swing trades, the 200-day for the big picture. 5. Watch the crossover. A faster line crossing up through a slower one is a golden cross, confirming an upturn. Crossing down is a death cross, confirming a downturn. Great for the trend, but remember it lags confirmation, not a precise entry. That is it. Slope, side, touch, speed, crossover. Run those 5 checks, and one simple line will read the trend for you on every chart you open. If this made it, click subscribe. We build a new trading skill from the ground up every week. And that is the moving average, the one line that reads the trend for you. It is just the average price, replotted every day. Its slope tells you the trend, it acts as a floor in an uptrend and a ceiling in a downtrend, and a crossover warns you when the trend is turning. Here is your homework. Open any chart and add the 50-day moving average. Read its slope, and ask whether price is above or below it. Then find one spot where price dipped to a rising line and bounced, and one where it rallied to a falling line and was rejected. Do that on 10 charts this week and the trend will stop being a mystery. If this gave you a tool you will actually use, subscribe. We build the next skill from the ground up every single week. See you in the next one.